Hi, everyone, and welcome to the November 2025 Knowledge Shop Tax Roundup. Great to have you with us. The ATO has just released updated guidance on rental properties and holiday homes, and a lot of the rental property rules are familiar, but the ATO's new approach to holiday homes is going to catch many people off guard. So Mike will be walking us through what's changed and what this means to clients. Mike will also cover some of the other key practical issues in the ATO's guidance. After that, we'll move over to Anne, who will discuss the finalised updates to PCG 2024/2, the shortcut method for valuing electricity costs when EVs are charged at home. And we'll also explain what's new and how it works in practice. And finally, as we head into the festive season, the ATO is reminding everyone that year-end parties, activities, and gifts can trigger FBT. So I'll be asking Anne to take us through the main things to watch out for. Now, let's get started. Mike, the ATO has released some updated guidance on the tax treatment of rental properties and holiday homes. While much of the guidance on rental properties is consistent with previous rulings and guidelines, the ATO's updated approach to holiday homes is going to come as a shock to many people. Mike, can you provide us with an update on the ATO's new approach and what it means for clients?
Well, the ATO has thrown us a bit of a curveball in the last few weeks with the release of some updated guidance dealing with rental properties with a particular focus on properties that might be classified as holiday homes. Now, just to take a step back, what we've got from the ATO over the last few weeks is 3 new draft documents. Important to note that they're in draft at this stage. We have a draft ruling, which basically runs through a 3-step process of dealing with income and deductions for rental properties. We also have 2 draft PCG, so practical compliance guideline documents. One of them deals with the apportionment of rental property deductions, and the other one deals quite specifically with the concept of a holiday home, where the ATO sets out its compliance approach and a few different risk zones in terms of how the ATO might view different property arrangements involving holiday homes. Now, it's the holiday homes aspect that is going to come as a bit of a shock to some people, and we're going to kind of explore this in a little bit more detail. But if we just take a step back and we think about the ATO's ruling and this 3-step approach that the ATO is talking about. So basically the way it works is the ATO says, look, if you've got a property, is it being used to produce assessable income? Now, you might receive some payments that are loosely connected with that property. It doesn't necessarily mean that those payments will be accessible to you. For example, you might have situations where you're receiving something that is probably more like board and lodging. So a payment that relates to the sharing of household costs, and consistent with previous ATO guidance in this area, the ATO suggests that wouldn't normally be accessible to you. I guess what we have here, as opposed to some of the previous guidance, is a little bit more depth in terms of that analysis and some further examples compared to what we had previously. So that's quite useful. So step 1, do you have a property that is being used to produce accessible income? If not, we probably don't need to worry too much about the tax impact, at least from an income or deductions point of view. Now, step 2 is to ask a pretty important question, and that is this property a holiday home? And that will be a question of fact. And basically we're looking at, is this home used by the owner, family, friends during the year for holiday purposes? And we would kind of think about that in a pretty ordinary sense. Do family members and the owner go and spend some holidays there, whether that's a weekend or an extended period? And that's a yes or a no. If that property is never used privately for holiday purposes by the owner, we can answer no. We can then move on to step 3 of the analysis, which really then looks at apportioning deductions in an appropriate manner. However, if we are dealing with a property that is classified as a holiday home, this is where things get a little bit more complex and where things take a little bit of a twist compared to maybe what we thought previously. Because if we're dealing with a holiday home, the ATO says that we actually need to consider a very specific provision in the Tax Act, Section 26-50, which deals with leisure facilities. And this is something that the ATO hasn't really referred to in the past, and the ATO acknowledges this in part of its guidance, suggesting that you won't really see previously public guidance from the ATO that links that provision with holiday homes that are also used to generate some rental income. So this is something we're seeing probably for the first time in a long time anyway, in terms of how the ATO might be approaching this. Now, if you have a holiday home and it falls within the scope of this provision, which deals with these leisure facilities, what that basically does is it prevents certain expenses from being claimed as a deduction, even if the property might be used to produce income for at least some of the year. Now, there are some exceptions to that, and one of the main exceptions to that is where that property is held and used mainly to generate rental income across the year. So if we have a property that is used sometimes as a holiday home by the owners, the next question really is this property used or held mainly for income producing purposes? Now, if the property is not held mainly for income producing purposes, and once again, that is a question of fact, we need to consider a range of factors to figure that out. Basically, what the ATO is saying to us is that this Section 2650 will kick in and it will prevent certain costs from being claimed as a deduction. And those costs would include things like interest on money borrowed to buy the property, land tax, council rates, and repairs and maintenance. So kind of typical things we would think of as holding costs. Now, let me just make this really clear. What the ATO is saying is that if the property is a holiday home and it's not held mainly to produce rental income through the year, there's a high likelihood that Section 2650 would deny any deduction at all for those expenses, even if the property is used to produce income for at least some of the year. So in the past, probably what we would have thought was, yes, we might have a holiday home. It might be used for a significant period for family kind of holiday use, or it might be held or set aside for that use. But we would probably still think we could claim deductions for at least some of the, say, interest expenses, and we would be apportioning those expenses looking at the number of days that the property was either rented or advertised for rent across the year. The ATO is saying is that's not the case anymore. And what the ATO would probably say is that it's probably never been the case. It's just that this isn't something the ATO had really brought to our attention in the past. It didn't seem like something that the ATO was applying in its own guidance. So this is the thing that probably is going to come as a shock to a lot of people who have these properties which are used for kind of holiday purposes by friends and family throughout the year, that yes, they might be used to produce income for some of the year. The threshold question, the really important question now becomes, is that the main purpose, genuine main purpose of the property or not? And we're going to have to look at the facts to figure that out. Now, when you do have a property that is classified as a holiday home and it's not held mainly to produce rental income across the year, that doesn't mean you won't be able to claim any deductions at all. It's just you'll be severely limited in what you're able to claim. And in that case, what the ATO suggests is you would be able to claim expenses that relate directly to renting out the property. So costs of advertising the property for rent, cleaning the property between stays. So things that are very directly and closely related to generating that rental income could still be deductible. They're just saying that there's a whole bunch of other things, typical holding costs, where no part of those costs would be deductible, despite the fact the property is used to produce income. So this represents a pretty fundamental shift in the ATO's guidance. And the ATO acknowledges that. As I said earlier, the ATO acknowledges that this section, 2650, it hasn't really been referred to in previous ATO guidance in this area. It hasn't been applied in many of the examples that the ATO has put to us through its extensive guidance on rental properties and holiday homes in the past. Acknowledging that, the ATO says, well, look, we're going to give you a bit of a transitional period. We're not going to devote compliance resources to check the application of 2650 until 30 June 2026 expires. From 1 July 2026 onwards, I'm guessing that means that the ATO will look to devoting compliance resources to clients who might be affected by that provision. Now, for those who might be incurring expenses already up to and including 30 June 2026, as I said, the ATO says they won't seek to devote compliance resources to checking whether those things are deductible or not. But that's only the case where they relate to existing arrangements that were in place when these documents were released. 12th November 2025 is your key date there. So a small window where the ATO is probably going to look the other way for a little while when it comes to these costs, but you can expect that probably to come to an end from 1 July 2026, when we can imagine the ATO is going to be a lot more strict when it comes to those types of holding costs being claimed as a deduction in connection with properties that would best be described as a holiday home. Now, the ATO, in terms of kind of determining whether a property would be classified as a holiday home or not, and also whether it is held mainly to produce income or not, this is where one of the PCGs, the draft PCGs, comes in, because it gives you some different risk zones, different kind of factors that would lend you to being unlikely to be reviewed or targeted by the ATO, but then some factors that would increase that risk. So the ATO would be looking at, for example, the number of days during the year that you are actually generating income from the property, the extent to which there was some private use of the property, the extent to which the property is blocked out during peak holiday season. So if it's a property on the coast somewhere, if you're not making it genuinely available for use for tenants for income producing purposes across, say, the school holiday period over Christmas, the Easter holiday period, that sort of thing, really high risk of the ATO saying that these rules are going to apply to you. Also looking at how hard it is you're trying to use the property to generate income. If you are listing your property for rent at rates that are well above kind of the average for similar types of properties in the area, that's an indicator that you're not really trying that hard to generate income from that property. These are the types of factors that the ATO will look at to determine the risk level of whether you could be subject to 2650 or not. So pretty significant shift in some respects for some clients. This will take a bit of time, I guess, to get heads around just in terms of what does that mean economically. We thought maybe we could claim a deduction for at least some of these pretty large expenses in some cases. If that's not the case anymore, it kind of changes the economics in terms of the viability of holding the property or how it's being used. So some important conversations that we might need to be having with affected clients over the next 6 months or so.
Thanks, Mike. Are there any other key practical issues covered in the ATO's latest guidance that we should be aware of?
Yeah, there are some important practical issues that come out of that guidance as well. To some extent, basically reiterating what the ATO had said to us in previous guidance, previous rulings in this area. But in other areas, it kind of builds on and adds to existing guidance, and I think can be quite helpful in some cases. Let's have a look at kind of two main areas where there's some practical impact coming out of this guidance. The first one is where there are arrangements relating to rental, arrangements with related parties. Now, taking a step back, when we have a property and it's being made available to a particular related party, whether that's a family member or a friend, and maybe where the amount being paid for the use of the property doesn't represent an arm's length or market or commercial rate of rent, we need to start with a threshold question of whether that payment or those payments would be assessable income or not. Does it really represent rent for the right to use the property? Now, that will depend on the facts. It will always depend on the facts. And one of the things we're looking at there is the payment really related to the right to use the property, or does it represent basically a contribution to household costs and expenses? If it's merely an amount to help cover some of the kind of household costs, it's unlikely that we're dealing with an amount that is classified as rent, in which case probably not assessable, but also means we can't claim deductions against it. Where the amount is being paid for the right to use the property, even if it's less than a market rate, well, that normally will be assessable. We need to include it in our client's tax return as assessable rental income, despite the fact that it, as I said, might be less than what a market rate would be. Now, if a property is being rented to a related party for less than market rates, we recognise the rental income, but what's probably going to happen is that there will be a limit on the deductions we're able to claim. Now, when you are making a property available to a related party, you're not charging the market rates of rent. The ATO basically says that you probably have two intentions or purposes when it comes to the expenses that you're incurring. One is to potentially generate some rental income, but the other one is probably to allow that family member or their friend to live in a particular property, your property, at an affordable rate. And that's a private purpose. And so because of that, the ATO says that even though you are generating some assessable rental income, there will be an impact on the deductions you claim. Now, in most cases, the ATO is suggesting is basically what you do is that you limit the deductions to the amount of assessable rental income that you're receiving from that related party. So you would expect in most cases for the tax outcome to be neutral. Recognise the actual income received, only claim a deduction for up to the amount of the rental income received for expenses, So you would expect in most cases kind of nil net income, nil net loss from that rental activity. So that's the first thing. The ATO is kind of clarifying their current position on what to do when properties are rented to related parties at less than market rates. The second practical area that the ATO addresses, and this comes from one of the draft PCGs, is some approaches that could be used in terms of apportioning expenditure when a property is either not rented for the whole year or where only part of the property is rented to tenants. So, for example, if you have a situation where the property is genuinely available for rent, but only for part of the year, we would typically expect an apportionment to be undertaken. And the ATO suggests that would normally be done on a day's basis. That would normally be acceptable. The thing that comes up a bit here is, what if you're living in a property, and let's say that you are happy to have a tenant rent out one of the rooms in your home. So you advertise that room for rent basically throughout the year. Sometimes someone's staying in the room paying rental income. Sometimes they're not. But when they're not, it's still being advertised for rent. Basically, what the ATO says is that for the periods during which someone is actually staying in the property and paying you rent, you would treat that as income-producing use, and there's a portion of your deductions that will be available. But where you are living in a property and there is no tenant currently staying in that property paying rent, you basically treat that as a private property as a whole, even if a room or part of the property is genuinely advertised for rent. Basically, the entire property is deemed to be a private asset at that point in time. So that's the ATO's approach, and the ATO is making that pretty clear. When you're doing that time-based apportionment, you do need to be very careful about those situations where a property or part of a property is advertised for rent, but it's currently being occupied by the owner for private purposes. The second scenario around apportionment is where basically you have someone staying in part of the property, but renting out part of the property, and we're trying to figure out to what extent do we claim a deduction for things like holding costs during that period of time. You might find that maybe a room is being rented out to someone, but they also have access to common areas of the property. That could be living areas, kitchens, bathrooms, patio, backyard, all those sorts of things. And there has been a real lack of guidance in the past in terms of how do we undertake that apportionment when it comes to, say, common areas of a property that aren't specifically allocated to a tenant. They don't have the exclusive use of that area. Effectively, what the ATO is suggesting as a common sense approach, and you're not bound by this, so you don't have to use this approach, but if you do, the ATO basically says they'll leave you alone, is when it comes to common areas, you just divide them by two. So if the owner is living in the property, they're using part of the property as their private residence, part of the property is being rented out to a tenant, and there are some common areas that are basically available to both the owner and the tenant, then the ATO says for simplicity, you can just divide those areas by two. As I said, it's not compulsory to use that. If you want to use a different method to apportion, you can, but it would then be up to you to prove that the method you've used is appropriate and reasonable in the circumstances. So we do have, I guess, on top of the nasty surprise that comes in terms of the focus on holiday homes, we do have some other very practical, useful kind of approaches that we can apply from this latest ATO guidance that can just make our life a little bit easier. If we choose, as I said, that's kind of up to you. So as you can see, quite a few things to unpack from these three new draft documents. These are just draft. We would expect them to be finalised at some point, probably next year, but it will take a bit of time, probably given that we've got a Christmas New Year break in the middle. We'll probably have some feedback provided to the ATO, particularly around the holiday home bit. So it might take a little bit of time for this to be processed, updated, and then released in final version. We'll certainly let you know once that occurs.
And the ATO has finalised its updates to PCG 2024/2, which provides a shortcut method for valuing the cost of electricity when an EV is charged at home, which can now also apply for plug-in hybrids. What are the changes?
Thanks, Amy. So the PCG 2024-2 basically provides clients with a shortcut home charging rate of 4.2 cents per kilometre to calculate the cost of electricity for charging electric vehicles at an individual's home. So this applies for both calculating car expenses from an income tax perspective and an FBT perspective when calculating the taxable value or residual fringe benefits. So prior to the updates, PCG only applied for electric vehicles and didn't extend to plug-in hybrids that use a combination of both electricity and petrol fuel. And there was basically no approved ATO method or guidance to calculate electricity claims for plug-in hybrids. Now in the updated PCG, the ATO has included a methodology that applies specifically for plug-in hybrid vehicles. The method has 7 steps that clients can follow to calculate the home charging electricity cost for their plug-in hybrid vehicle. So without getting into the details, this involves calculating the total petrol kilometres by dividing the actual quantity of petrol purchased in the year by the petrol consumption rate, which needs to be obtained from the manufacturer for that vehicle. You then calculate the total annual kilometres based on the odometer readings, and then you work out the total kilometres driven by the vehicle using electricity and calculate the total electricity cost by multiplying this by the 42 cents home charging rate. Finally, the total fuel expense for the year is calculated by adding the actual petrol costs with the total electricity costs. So if clients follow the 7-step method in the PCG, then the ATO does not have cause to apply compliance resources to review the calculation of the electricity costs for FBT or income tax purposes. The method is optional and can also be applied on a year-by-year basis. And the guideline also introduces a transitional approach for the 2024 to 2025 FBT and income tax years. So at a high level, where odometer records or substantiated petrol cost records haven't been kept for that plug-in hybrid at the start of the year, employers can still use a reasonable estimate based on service records, logbooks, or other reliable information that they have. Overall, the updated PCG provides long-awaited clarity for clients that have plug-in hybrids.
Thanks, Anne. With the end of the year fast approaching, the ATO is also reminding clients that year-end parties, activities, and gifts may attract FBT. What are some of the things to be aware of?
Thanks, Amy. So one of the main things to note in relation to end-of-year celebrations is that Section 32-5 generally prevents deductions from being claimed for entertainment expenses unless a specific exception applies. The main exception to this is where the provision of entertainment gives rise to FBT. What this means is that where you have entertainment but no FBT is payable, then deductions for these costs are generally denied. For Christmas or end-of-year parties, the location of the event is critical in determining the FBT outcome. If the event is held on a working day and on the employer's business premises, and only employees attend, the food and drink provided is generally treated as an exempt property benefit, meaning that no FBT is payable regardless of the cost. Also, the costs of paying for employees' travel to and from the event would also be exempt if it's on-site. However, if the associates of the employees attend, the costs for those associates will be subject to FBT unless, for example, the minor benefits exemption applies. In contrast, where the event is held off-site, the exempt property benefit can't apply. In that case, you would need to consider whether the $300 minor benefits exemption can apply. So where expenses are exempt from FBT under the minor benefits exemption, this generally prevents deductions from being claimed and also denies GST credits under Section 69-5. As for paying for travel to an off-site venue, only trips between the workplace and the event would be exempt from FBT, unless the total entertainment costs per person, including the costs of the event and the travel, is less than $300, including GST. So if an employer provides an employee with multiple benefits in connection with the same function, for example, a Christmas party plus a gift, those benefits may be treated separately for the purposes of the minor benefit exemption, provided that each benefit can be clearly identified and valued. So this is confirmed in the Taxation Ruling 2007-12. So for example, if an employee receives both a gift worth less than $300 and also attends a Christmas party costing less than $300 per head, these are treated as separate benefits for this aspect of the minor benefits exemption. However, they must still be considered together when you're looking at whether it would be unreasonable to treat the benefits as fringe benefits.
Good.
In terms of gifts provided to employees at a Christmas function, these are generally not regarded as entertainment unless the nature of the gift itself is entertainment. So non-entertainment gifts, such as hampers, wine, gift cards, or personal items, are generally deductible unless they're treated as tax-exempt body entertainment benefits. So where the value of a non-entertainment gift is under $300, the minor benefits exemption may eliminate FBT from applying. However, if the gift exceeds $300, then FBT will apply, but the employer will usually be entitled to a deduction and a GST credit.
Thanks to Mike and Anne for walking us through the ATO's latest guidance on rental property and holiday homes, to the updated EV shortcut method and those year-end FBT reminders. As always, Knowledge Shop members have access to resources, training, and our help desk support to stay ahead and help their clients with confidence. If you have any questions or just want to have a chat, reach out anytime. And that's a wrap for the November 2025 Tax Roundup video, our last one for the year. Thank you so much for your support in the last year. And from all of us at Knowledge Shop, we wish you a happy holiday season and a fantastic start to 2026. We'll be back with more video roundups in early 2026.